Most people think investing success comes down to picking the right stock, choosing the right fund, or finding the perfect time to enter the market. And that belief is understandable, because that's where most of the noise is. But when you look at how people actually struggle with investing over the long run, a very different story emerges. The biggest investing mistakes rarely happen in the market itself. They happen before the first dollar is ever invested. They happen quietly. They happen early. And by the time people notice, the damage is already done. People invest money they can't afford to leave untouched. They invest without understanding their own cash flow. They invest while carrying expensive debt or without any real safety net. And when life happens, as it always does, those investments stop feeling like progress and start feeling like pressure. Today we're going to talk about what to fix before you invest a single dollar. Not theory, not trends, but practical, proven steps supported by mainstream financial planning principles and trusted financial guidance. Before risking money in the market, there's another step that's easy to ignore but impossible to replace: an emergency fund. An emergency fund protects your long-term plan from short-term chaos. Because chaos is not rare. Jobs change, health issues happen, cars break, families need help. Without a cash buffer, investors are forced into bad decisions at the worst possible moments. That's how temporary problems become permanent setbacks. This money isn't meant to grow. It's meant to wait. An emergency fund doesn't improve returns. It protects behavior. Once you have a safety net, the next thing to confront is high-interest debt. This is where emotion steps aside and math takes over. If you're paying 18 or 20% interest on debt while hoping your investments earn 6 or 7%, you're moving backward. That's not mindset, it's arithmetic. Financial success isn't just about doing the right things, it's about doing them in the right order. Stability comes before growth. Before investing a single dollar, this is the foundation that needs to exist. You understand money. You know where it goes. You have protection. You've reduced risk. You follow a clear sequence. You know your goals. And your savings happen automatically. None of this is exciting. None of it feels urgent. But this is what allows investing to work the way it's supposed to. Investing does not create stability. Stability allows investing to succeed. And the most important investment decision you'll ever make isn't what you buy. It's whether you are ready to invest at all. Because investing doesn't reward urgency. It rewards preparation. Before investing, the most important thing to fix is financial literacy. Not market literacy, not stock-picking skills. Financial literacy. This is about understanding how money actually works in your life. It means understanding budgeting, saving, debt, planning, and basic risk. It means knowing what happens to your money after it hits your bank account, and why it sometimes seems to disappear. People with stronger financial literacy consistently make better financial decisions. They save more regularly. They build emergency funds. They rely less on high-interest debt. But just as importantly, they panic less. This matters because investing is emotional long before it's mathematical. If you don't understand how money flows through your household, investing feels abstract. Headlines feel personal. Market dips feel like failures. And every decision carries more stress than it should. Think of investing like planting seeds. Financial literacy is the soil. If the soil is poor, even good investments struggle to grow. But when the foundation is solid, investing feels calmer, slower, more intentional. Before investing $1, you should be able to say clearly where your money comes from, where it goes, and what risks could disrupt your plans. Investing doesn't just start early, it starts fragile. Once you understand how money works, the next step is clarity. And clarity comes from budgeting. A budget isn't about restriction, it's about honesty. If you don't know exactly what you earn versus what you spend, investing becomes guesswork. You might feel like you're moving forward until something small knocks you off balance. Budgeting ensures that essentials are covered before money is sent into the future. One simple and widely used framework is the 50-30-20 rule. About 50% of your income goes to needs, about 30% goes to wants, and about 20% goes to savings and investing. This rule isn't about getting the numbers perfect. Its value is perspective. It forces a simple but powerful question. How much money do I actually have available to invest without creating stress later? Without a budget, investing becomes inconsistent. And inconsistency does more damage over time than market volatility ever could. Budgeting isn't optional. It's the difference between investing with confidence and investing with crossed fingers.